Missing just the 10 best days in the stock market over the last 30 years could slash your retirement savings in half. That is not a scare tactic. It is, according to research from J.P. Morgan. Yet, almost every investor, even the most experienced, falls into this trap. Panic selling at the worst moment and locking in losses instead of staying the course. If you have ever worried about a market crash or felt your stomach drop when your account dipped, this is critical. The biggest investing mistake is not picking a bad stock or missing a trend. It is letting your emotions push you out of the market at the exact wrong time. But what if you could sidestep these costly mistakes and actually profit while others are paralyzed by fear? I am Mark from Mark Invests, and in this video, I will reveal the 5 rules for panic-free investing. Backed by real numbers, stories, and data you can use to protect your future, starting today. Let's dive right in. The stock market's wild swings mess with even the most seasoned investor's confidence, right? One day you are up, next day you are down, and every headline makes you question your plan. But learning how to avoid panic, tune out noise, and make smart choices, especially when things get dicey, is exactly how wealth is built for the long term. That is why today's framework is so crucial. I call it the 5 rules for panic-free investing. Stick around because rule number 5 is the rule almost everyone ignores, and it is often the most profitable. Ready? Rule number 1, never try to time the market. Let me start with a quick story. Imagine an investor. Let's call her Lisa. In March 2020, after seeing her portfolio drop 20%. In just days, Lisa sold all her stocks and moved to cash, convinced things were just getting worse. For the next few weeks, she anxiously checked the news, waiting to see proof it was safe to re-enter. But the market rebounded at lightning speed, recovering much of its losses in just weeks. By the time Lisa felt confident again, she had already missed a huge chunk of the recovery, essentially locking in those losses. Here's what is wild. Over the past 20 years, according to J.P. Morgan, 7 of the S&P 500's 10 best days happened within just 2 weeks of the 10th. Worst days in 2020 alone. March 12th was the second worst day, but March 13th, the very next day, was the second best. So if you missed even a few of those critical rebound days, because you were sitting on the sidelines, your long-term returns could be wiped out, missing just the best 10 days in the S&P 500 between 1990 and 2020 would have cut your total return from 10.2% per year to just 5.6%. If you missed the 50 best days, returns would have turned negative despite 3 decades of overall gains. Sources like Wells Fargo and J.P. Morgan have run analysis after analysis on this, and the message is always clear. It is time in the market, not timing the market, that builds wealth. Comment below with staying strong if you have. Ever felt nervous watching the market swing? You are absolutely not alone. And our community learns and wins together by sharing these stories. Let's move to the next rule. Rule number 2. Turn down the noise. The emotional roller coaster the headlines create is real. Every drop leads the news cycle, and every rally is hyped up as the next big thing. The media fuels fear and greed because it keeps you glued to the screen. Research shows that people who check their portfolios daily experience more stress and make more investing mistakes than those who check once a week or even monthly. There is a reason you have never seen a front-page headline like "Markets on track for steady average growth." That would not make anyone panic scroll or click. Instead, it is always "Crash coming" or "Record highs. Get in now." It is no wonder many investors feel whiplash, jumping between euphoria and disaster with every headline. And it is not only the news. Social media is even more extreme. One influencer predicts doom. The next promises a new golden era. it is easy to get caught up. The truth is, you can find a convincing data point or chart for almost any outlook, bearish or bullish, if you try hard enough. But cherry-picking stats distorts reality. Here is a myth versus fact sidebar. Myth: you need to follow the news to protect yourself. Fact: most actionable, relevant investing decisions are unaffected by day-to-day headlines. That is why so many successful investors literally ignore financial news entirely, focusing on their plan instead. According to a Vanguard study, investors who traded the least and ignored short-term drama outperformed their more active, news-following peers by up to 1.5% per year over 2 decades. After all, Warren Buffett famously reads annual reports, not daily news. Let's lock this in. Check your portfolio less often, automate your plan, and build in intentional, media-free time. That is the path to fewer mistakes and more peace of mind. And before you go, I want to drop a shareable principle here. It is not about timing the market. It is about time in the market. That one quote can save you literally decades of anxiety. Screenshot it. Write it on a sticky note. Whatever works. Rule number 3 is coming up, and it is the psychological anchor most investors overlook. But first, a quick curiosity loop. Which do you think hurts people more? Panic selling during a crash, or piling in at all-time highs from fear of missing out? I will answer that with a real dollar example in a minute. Rule number 3, automate. Do not agonize. You have heard of dollar cost averaging, but let's get specific. Automating your investments means setting up recurring transfers into your portfolio every week or month, no matter what the market is doing. Let's say you invest $500 per month into an S&P 500 index fund. Historically, around 10% annualized return. Though this is not guaranteed and past performance does not predict future results. Some months you will buy when prices are low, others when markets are high. Over time, this smooths out your purchase price, meaning you benefit from dips and do not have to guess at perfect timing. According to Vanguard and Fidelity, investors who automated their contributions consistently, even through market crashes, ended up with portfolios that beat not only market timers, but also those who waited in cash for the right moment. And here's the key: automation eliminates the temptation to second-guess yourself or jump in and out emotionally. In fact, the data shows that the average investor trying to time the market underperforms the broader S&P by about 1 to 2% per year, simply because of missed days and panic moves. Want the 5 rules checklist I use with my own subscribers as a desktop reminder? Comment checklist below and I will send you the free download link. Keep it visible. It will save you money and stress. Now, let's clear up that curiosity loop. Is selling at the bottom worse than buying in at the top? The truth. Both hurt, but selling at the bottom when markets crash can wipe out years of gains. For example, if you invested $10,000 just before a 25% market drop, but sold after the loss and waited a year to return, you would have only $7,500 and could easily miss a recovery that brings the market back to $11,000 or more by staying on the sidelines. Both mistakes are expensive, but panic selling is almost always the costlier error. If that has ever happened to you, you are not alone. It is the most common behavioral trap. According to a Dalbar study examining real investor returns versus market returns over 30 years. Rule number 4. Separate emotion from execution. This may be the most underestimated rule. When you look at your phone and see a 3% drop, your brain's threat response kicks in. Suddenly, your plan feels wrong. Your gut says, run, and even your friends may be texting to get out. The truth is, our brains are wired to react to danger, but unlike with predators, Emotional investing backfires. Behavioral finance research shows that making buying or selling decisions in a state of high emotion leads to consistently worse results. A 30-year analysis of Average Investor Returns by Dalbar showed that investors' actual returns lagged the S&P 500 average by 2 to 4% annually. Why? Emotional decision-making and overtrading. Legendary investor Peter Lynch put it best. Far more money has been lost by investors preparing for corrections than by corrections themselves. How can you actually separate emotion from gut? Execution. By pre-committing to rules before the panic hits. For example, decide right now, if my portfolio drops more than 10%, I will not sell anything for 30 days. This kind of speed bump prevents knee-jerk reactions, or only allow yourself to check your performance once a week, not daily. And remember, your real job is not to outsmart the market. It is to out-discipline your emotions. Let's pause for a quick engagement. What is your biggest investing fear? And how do you deal with it? Leave your answer in the comments. You never know who you will help with your perspective. And if this is making sense so far, just drop a money bag emoji below to let me know. We are approaching the final rule, and it is the one that saved my portfolio during one of the worst crashes in recent history. Stick with me. Rule number 5. Have a written plan before the crash. The riskiest time to make big investing decisions is in the heat of the moment. The calmest, smartest thing you can do is write out your strategy and rules when things feel stable, and then stick to them when chaos hits. What should a panic-proof plan include? Decide in advance your asset allocation, stocks versus bonds versus cash, your monthly contribution, and under which, if any, circumstances you will rebalance or sell. For example, I will continue to contribute $300 per month to my index fund, regardless of market moves. I will rebalance once per year, not after headlines. I will only sell if I need cash for a true emergency. In 2008, during the financial crisis, those who had a plan and stuck to it generally saw their portfolios more than double in the first decade after, even as friends who bailed out sat on the sidelines, missing the record rebound. From 1990 to 2025, the S&P 500 averaged roughly 12 to 13% annually, including down years. If you remove the negative years, that average jumps to about 19%, illustrating just how strongly recoveries drive long-term growth. The lesson? You do not have to be perfect, but you need to be consistent. And your plan is your anchor. Here's my own case study. In the pandemic crash of 2020, I stuck to my automation, made no changes, and checked my portfolio just once a month. The end result? Not only did my investments recover, but my overall stress level was far lower than my work. Friends constantly glued to the news. That brings us to an essential myth-busting moment. Myth? You can always spot when the market's topped or bottomed by watching trends or expert forecasts. Fact? In the last 20 years, no professional has been able to consistently predict major turning points in real time. Those calls are only obvious in hindsight. Let's do a quick recap and make sure you are ready to put this into action. But before that, if you want a printable checklist of all 5 rules to put on your desk or fridge, just comment checklist below. I will get you the link. Here is what you should remember. 1. Do not try to time the market. Missing just a few days can destroy decades of gains. 2. Turn down the noise. Ignore headlines. Minimize portfolio checking and automate your system. 3. Automate both your contributions and rebalancing, so emotion never gets a grip. 4. Separate emotion from execution with pre-committed rules and speed bumps. 5. Have a written plan prepared before the next crash hits, and stick to it no matter what. Share this video with anyone who is losing sleep over their investments. Remember, building wealth is not meant to leave you anxious. The most effective strategies are simple, boring, but relentlessly consistent. You do not need to be perfect, just committed. What about tools? Set up automation with your brokerage. For example, Fidelity, Vanguard, or Schwab all offer scheduled transfers. Track your long-term progress using apps like Personal Capital or YNAB. And if you want to test how different strategies play out, experiment with free online calculators like Portfolio Visualizer. And above all, if you are ever worried, revisit your written plan and reach out to a licensed financial advisor for professional, personalized advice. Everything we discuss here is educational, not a recommendation to buy or sell any specific investment, and past performance is never a guarantee of future results. Do not forget, rule number 5 is the rule that separates the investors who sleep well from those who constantly second-guess. I promise, implement these steps and your peace of mind, not just your returns, will grow. Let's quickly recap what you have learned today on Mark Invests. The 5 rules for panic-free investing are: 1. Do not try to time the market. Missing just 10 days can slash your returns by half, so stay invested. 2. Turn down the media and social noise. Focus on your plan, not the headlines. 3. Automate everything. Consistent contributions and rebalancing beat emotion. 4. Separate emotion from execution. Use written rules and check-in limits as your good way. Buffer. 5. Write your plan before the crash and let your represent system work, not your nerves. Here is what you do next. Today, review your investment accounts and set up automatic transfers, even if it is just $50 or $100 a month. This week, put your written rules somewhere visible, on your desk, in your phone notes, wherever you check your finances. Over the next 30 to 90 days, build the habit of checking your accounts just once a week and ignoring financial noise. In 6 to 12 months, you will likely be more disciplined, less anxious, and possibly outperforming those who chase every headline. Remember to use tools like your broker's automation feature, tracking apps like Personal Capital, and free sites like Portfolio Visualizer for scenario planning. If you want immediate reinforcement, comment checklist, and I will send you the 5 rules download to print. Ready for real results? You will notice peace of mind almost immediately as stress declines and you become less reactive. Usually, you will see the financial benefits build within the first year. More consistency, fewer mistakes, and a clearer path towards true wealth. Stay with our Mark Invests community. Subscribe and turn on notifications so you do not miss out. Next time, I will be sharing the most overlooked ways index fund investors can cut their risk without sacrificing growth backed by decades of real-world data. If you found this valuable, share it with friends or family. It may save someone else from an expensive mistake too. And do not forget to comment below. What is your number 1 investing question or challenge right now? I read every comment and might feature your minute, story, or question in a future episode. Everything discussed here is for educational purposes only, not financial advice. Your individual situation may differ, and past performance does not guarantee future results. For major investing decisions, always consult a licensed financial advisor.